Hey everyone, how's it going? It's Derek. Today I just wanted to go over my binary option strategy I've been using, the zero gravity strategy. It's a pretty simple strategy and you really only need two indicators, so it's pretty easy to follow. Now I did have a third indicator, but I realized that it's not really needed, so I actually took it out of the strategy. So it's only two you need. So I use the Keltner channel. You just leave it at default settings, 20 and 10. And then I use a stochastic oscillator, keep that at the default levels of 14, 3, and 3. Alright, so the way the strategy works is like this. Okay, when you see, the way it works is like this. The Keltner channel, pretty much it shows you when your market is going overbought and oversold. And in that same principle applies to the stochastic oscillator. So you can see right here, let me move it right down here. Okay, could you see these lines right here, 20 down here and 80 up here? When the lines are above this 80 mark, that means we're in an overbought market. And when we see that the lines are below this red line right here, that means that we're in an oversold market, right? Now, the strategy works like this. This was originally a 3-minute strategy, but I modified it to a 2-minute strategy. The reason I modified it to a 2-minute strategy is because I know sometimes reversals can happen pretty quickly. So this is what I do. When I see a green candle, a green engulfing candle, which means that majority of the candle is the solid, not the wicks. So something like this, it would actually still work. But to be a little safer, I typically wait for an engulfing candle. Doesn't as long as the candle crosses. I don't want to complicate it for you guys. So as long as the candle crosses a green candle crosses above the Keltner channel, right? And you see, that means it's going into overbought conditions. So when a green candle goes into overbought conditions by crossing the Keltner channel, and you see these lines in the stochastic oscillator cross into the 80 mark, which is the top green line, you know you're in an overbought market. So when you're in an overbought market, typically what the market likes to do is correct itself. So when you see both the stochastic oscillator down here crosses into overbought, and you see the Keltner channel goes into overbought, you're going to see a reversal, as you can see right here. So what happens is when I see this candle close, what I'll do on this candle here is I'll wait maybe a few seconds, like maybe 30 seconds, just to see if the candle's turning red or green. And when the mark gets between, see how this countdown's going right here? When the countdown's between a minute and 20 and a minute and 10 seconds remaining in the purchase time, if I see the candle's red, what I'm going to do is I'm going to enter a put position for 2 minutes. So you just wait for the call. You just wait for the candle to materialize. And again, it's not 100%, but it's pretty accurate, right? And likewise, when you see the red candle crosses down into the Keltner channel into oversold conditions, and here it's not all the way into oversold conditions, but it was starting to go into oversold conditions. Typically, that means another reversal is going to happen. So as you can see, it reverses back up. This method works best in what's considered a consolidated market, like you see like this, where it's kind of just like hovering. That's why I call it the zero gravity mode, because I used to, what I would do is if I were to make an indicator for a moving average, for a 50 moving average, I'll show you guys. What you'll see is most likely, I guarantee you, this line is the candles are going to be going right around it. So let's see. All right, so I set this moving average at 50, and pretty much what this moving average does is it tells you if you're in an uptrend or a downtrend. So when you see that the candles are above this 50 moving average, this means that we're in an uptrend, right? Which means I'm going to have a bias to reversing going up. So my bias is going to be call options when my candles are above, and my bias is going to be to put options when it's below. As you can see, this is a long-standing downtrend. Okay, so when I see something like this, where the candles are pretty much going around the white line, that means we're in a consolidated market. When you see it looks more like a nice sine wave, nice and even, That's typically it's called a consolidated market, or it's also known as a range market. So the strategy works really well in that type of market. You really can't go wrong with it. Now, there are places where the strategy is absolutely, it just doesn't work. And let me show you. I've actually missed some good trade setups, but it is the weekend. I don't like to trade on the weekend anyway. All right, so something like this, I want you guys to avoid. All right, so you see how this is like a long-standing red, like this is just like a red party over here. Like, look at this. When you see something where the red candles are just surfing along the bottom of the Keltner channel, and when you see the stochastic oscillator is pretty much just going straight, it's not really oscillating up and down, too much movement. Typically, that means it's a long-standing downtrend, and I would not use this method for that, because what this method does is it relies on strong reversals, and you really can't get a strong reversal when you're in something like this where you're just surfing down. It's a long-standing downtrend, because it's really hard to find your entry point. And not only that, even when it does reverse, you only have a short window, and you have to make sure your entry point is really good. Otherwise, look at that. This is a very short amount of entry that you could do and actually be profitable when the candle closes. So we know the candle closed above here. Even though you see it going up and everything's pointing to it, this long-standing downtrend ending, I just avoid it. I'm not saying you can't win trades like that. I just typically avoid when I see the candle surfing up or down for a prolonged period of time. Like right here, I would never do this method here. Let me see if I can find something else. See, oh, wow, this is a long-standing downtrend, as you guys can see. I want to show you guys something else. I want to show you guys the opposite, where it's a long-standing uptrend. Let me see if I can find something for you guys. Something like this, I would never do this method in. As you can see, the green candles are consistently above the Keltner channel, which means, again, we're in an overbought market. And you can even see the stochastic oscillator. It's just in a straight line pretty much. Avoid doing this method with that. I have to drive that point home, because when I first discovered this method, I learned it from someone. She did not go into all the nuances. She just pretty much said, when you see the red candle go below the Keltner channel, do a 3-minute trade, it's going to reverse. And that method works well until it doesn't. And the best way to make sure this method works is I add a few qualifications. Number one, I only enter this trade if you're in a ranged consolidated market. Do not enter when you see a long-standing downtrend. It's a waste of time. You're going to lose a lot of money. You're going to get frustrated, and you're going to be like, oh, this method doesn't work. And what you're going to do is you're just going to keep cycling through a bunch of different methods. And, when you cycle through a million methods, that's when it doesn't work. Another time I don't enter this method is if you see a bunch of engulfing candles right next to each other. As you can see, when it looks like this, don't even bother. Like, what you want to see is movement. When the market's starting to go horizontal with a bunch of engulfing candles, typically what that means, in the engulfing candles, there's not really much movement. It pretty much means that the market, it's volatile. It's a volatile market, and this method does not like volatile markets. It likes smooth, crystal clear water type markets. All right, so something like this, it's volatile here. All right, as you can see, when it got to the half-hour mark, something that Matty Pips often talks about, trends tend to change every half hour or 15 minutes. As you can see, once it got to the half-hour mark, the volatility kind of slowed down a little bit. It might have been there was 3 bull news going on. Always make sure you go to the economic calendar. So just make sure you go to the economic calendar and make sure there's no 3 bull news, because that could also lead to volatility for a few hours. Because this method, again, it really likes it when it's like a smooth moving market. As you can see, the long-standing downtrends. So consolidated markets don't last that long. Typically, I'll find them in the morning between 6 a.m. Eastern Standard Time to noon. Anytime after like 2 p.m., I typically don't do this method because the markets are way too volatile. There's too many things going on. So I'm going to show you, see how this right here, that's a volatile market. When you see really big engulfing candles, just don't even bother. Now, it stops the volatile market and it goes into a more consolidated market here. It's trying to correct itself, and it's actually doing the rule, but it's not doing the rule in actual actual overbought, an actual overbought market, and it did reverse back down. But that was just the volatility. So as you can see, the red candle did cross, all right, and now you can see that that we're going to another red engulfing candle, and then it reverses back up. Now, a lot of people will see this and they'll be like, okay, if it's going down, how do we know when to enter our trade? How do we know if it's going to actually reverse? Because you're telling not to just enter as soon as you see a red candle. You want to wait for a green candle to start forming. Now, if you want a very good entry point, what I suggest you do is look at the stochastic oscillator down here. When you see this line here, the blue line, cross into the purple line, as it starts trending upwards, you know it's going to start trending upwards because the lines are actually going to intercept each other. All right, so as you can see, the lines intercept, and whichever the blue line is going, whatever direction the blue line is going to, it's going to determine if it's going to be a call or a put. So see right here, it crosses up, you're going into a call. It crosses below, you're going into a put. It's just that simple. That's why I love the strategy. I love that I added on that new nuance that you needed for this method to really truly work. As you could see, the red candle crosses into oversold conditions here, and it's crossing into oversold conditions here. But what's going to determine ultimately if it decides to, correct itself is when you see the blue line actually cross up into the purple line, and there you go. It corrects itself back as a call option. I'm going to show you a couple more. Here's another one. The red candle crosses down into oversold, crosses down to oversold in this minute candle. Another thing, I'm doing minute candles, as you guys can see, and I'm doing 2-minute trades. So right here, you could see the blue candle. Sorry, you can see the blue line in stochastic oscillator. It actually made like a sharp turn. This is typically an indicator that the reversal is on its way. When I see that the blue line makes like a, I guess you could call it like if you see it like change angles, you pretty much know that the direction of the trend is going to change. So as you can see, red candle crosses into oversold. In the Keltner Channel, stochastic oscillator is crossing into oversold conditions as well, and this line turns. It makes a sharp angle, meaning it's about to intercept with the other line in stochastic oscillator, and now it trends upwards. You can see this repeat itself over and over again. Now, I want to also show you when you never do this method. When you see the stochastic oscillator and you see it just crossing itself a lot, you know you're in either a volatile market or you're in an uptrend market. Typically, when you see the lines crossing each other inside, it's just a really strong volatile market. When you see the lines just crossing each other a lot, let me zoom in for you if I can. When you see the lines like crossing each other a lot here, you know you're just in a continuous overbought market. So again, I typically don't do that. What you want to look for is nice, clean crosses with a healthy amount of distance between them. So you can see the stochastic oscillator here. See how the lines, they separate from each other? When you see the lines separate, you know that the trend is going to continue. When you see the lines get closer together, you know the trend is not really a trend. You know it's more volatile. So when you see a nice healthy distance, you see the lines starting to separate each other, you know that the trend is strong. It's a nice healthy trend, not a strong trend, meaning a trend that's going on, for a half hour to an hour, but it's a nice healthy distance, meaning you can see that the lines separate from each other right here. So then when you know that you see this angle right here, you know we're setting up for reversal. And as you can see, the lines did intercept and reversal has happened until you get to here. The lines, again, they separate and then boom, see that sharp angle? When the sharp angle comes down, the lines, now the candles begin to go down. Now, if that type of technical analysis is too much to handle, another thing that I would do, I'll show you, is I'll wait. I'll be in oversold conditions, and what I'll do, or overbought conditions or oversold conditions, right? And what I'll do is I'll wait for my first engulfing candle of the opposite direction. So when I see a green candle in overbought conditions, okay, it closes, and now I see a red candle close, but it doesn't close engulfing. That means there's been a little bit of indecision. So what I'll do after that is I'll say, oh look, there's an engulfing candle here. So I'll wait to see if the next candle goes red or green, and again I'll wait until this countdown timer gets to between a minute and 20 seconds to a minute and 10 seconds, and I'll know that the trend's going to continue, and then I'll enter right here. All right, that's it, and I'll do it for a 1 minute trade. That's if technical analysis is just too much for you to understand. It's just too complicated. All right, another way to know that this method's going to work and you're going to get a good reversal is to look at support and resistance. All right, so what I typically do, because I noticed I would get this thing called the breakout fake out when I think that, okay, the green candle crossed, over, the green candle crossed over the Keltner channel and then up, into overbought conditions. And you do it, if you try to do it right here, you get faked out. And the reason you get faked out is because you have to look at support and resistance levels as well. So a lot of times what I'll do to avoid getting faked out is, as I see the trend is going down, I see the candles are starting to go down, and I'm waiting for a reversal. I see that the lines have a healthy amount of distance between them. Okay, we're going to set up for a nice reversal. What I'll do is I'll draw in a line right here for support, as you can see. Or you could do a line for resistance. I'll show you a good setup for resistance in a second. All right, so I'll do support here. All right, and what I'll do is I'll wait for the red candle to hit support, and wait for it to close, and then instantly I'll go into a call for 2 minutes. Because again, it could break through support, but the chances aren't likely that it will. So it does give, it's just another confirmation that your reversal is going to happen. And as you can see, the reversal did happen here, right? And now we're just in a pure consolidated market here. You can see this thing play out time and time again. You can see it's hitting supports. You can see it's hitting resistances, typically right here. And what I like to do a lot is I like to wait for I like to draw out my line, and I'll just stalk my pair until it reaches the resistance mark. So you can see resistance right here. All right, this is the perfect type of market you want to trade in, a nice consolidated market. It's not too spiky, and there's not too many engulfing candles next to each other in a horizontal way. Okay, so here is another example. Here you'd see, okay, the red candle crossed the Keltner channel. I'm going to go into a call, but again, you'd get faked out. Now, this doesn't happen all the time. It's rare that this happens when you get faked out, but it happens so often and often enough to annoy you. So what I'll do in a situation like this, let's say I were to enter here and I'd lose my trade. What I do is I'd zoom out. As you can see, just zoom out. Sometimes you could do like a minute or so, an hour or so, to hour candles, and I would zoom out here, and I would just try to see when the next where the next support level is. So I'd look back and I'd say, oh, the support level's here. So what I would do is I would avoid this this pair until I see it hit another support level. And when it hits the support level, you know it's going to shoot back up, as you can see. All right, I hope this makes sense to you guys. This is pretty much what I do for like 90% of my trades. And again, I want to show you guys more what to avoid than just what to do, because it's easy to say, it's easy to just show this in a nice consolidated market like this and say, oh, look, it crossed down, and it hit support, it's going to shoot back up. But again, you really want to avoid things like this, long-term downtrends where the candles are surfing beneath the Keltner, or even long-standing uptrends where the candles are surfing above. So right here would be a good time to make a trade, and I'll show you why. All right, so I'm just going to zoom back in. Actually, I would wait a couple more minutes for this one. Let's see. Yeah, I would, after it crosses, this would actually be a good point, because as you can see, we're going to go into overbought conditions when it gets there, and the stochastic oscillator is also in overbought conditions. Another awesome confirmation is that we're below the white line of the 50 moving average, which means we're in a downtrend, which means that the candles are more likely to reverse down than up. So you most likely should have a bias towards puts than calls. So once this crosses the once the green candle crosses this, the Keltner channel, and I see that there's a healthy distance between the blue line and the purple line in stochastic oscillator, I know that it's setting up for the perfect reversal. Another thing I'll do is I'll look to see a support level. Now this was once, let's see, this was once a support level, which means it's going to be my new resistance level most likely. Which means the candle should go up to 588 before it does an ultimate reversal. This is also a good support level right here. But like I said, 588, see that? It's going to go to 588 and then I'm going to enter. Also, I see that the blue line is starting to make a sharper angle, which is another indicator of a reversal. So as you can see, if I would have just entered because it crossed, I would have gotten faked out. But you see, I'm stalking it. I'm actually waiting for the setup. Don't chase the trades. Make the trades chase you, and you're most likely to win. So as you could see, it did hit this point right here, which was a good resistance level, which was once a support level. So what I'm going to do is I like to see if it retracts back up. And once it retracts back up, I'll enter my trade. See, the lines crossed each other, intercepted. And now I know that we're going to go into a strong reversal. So as you guys can see, I want to show you this. It's very important. See, I waited for the trade to happen, and it happened exactly where I called it. The biggest lesson I learned, because when I first started, I blew like 4 accounts. I'm not even going to lie. I'm not going to cap. I did blow my accounts because I was just overzealous. I'm like, oh, this strategy works. I was 100%ing my risk management. It was just horrible. But what I realized is, when someone told me, because I was very frustrated, and I was Googling, I was like, why does it work sometimes, and sometimes I feel like it's like playing with me. And what someone told me, and a really smart man, he said, don't trade what you think the market's going to do. Don't trade what you think the chart is going to do. The chart is already telling you exactly what it's going to do. The chart tells you where it's going. So instead of trying to force trades, instead of trying to chase trades, instead of trying to think that you're smarter than the market knows what the hell it's doing. The market knows. If that makes sense. The market doesn't lie. You know, the market isn't biased against you, because that's something that I thought at the beginning too. I'm thinking like, oh, the markets they just hate me. What I was doing was I was trying to predict where the market was going. Stop trying to predict where the market's going. The market tells you what it's going to do. It tells you exactly what it's going to do. You see how I broke everything down, how the reversal was happening, how there was a healthy distance between, you know, the two lines in the stochastic oscillator, how they were in overbought conditions, how the green candle was going above into overbought conditions, and exactly where the resistance, which was once a support, now became a resistance for this portion of the chart. And I told you exactly where the reversal was going to happen. And instead of me saying, oh, the setup's happening now, I'm going to jump into the setup, I just took the setup. As you could see, I just won that trade. I didn't have time to do my little corny 10-second countdown. I always do the 10-second countdown. But again, as you guys can see, that's how you stop yourself from getting the fake out. Because just look for support and resistance. It's very important. Make sure that you don't chase the trades. Have the trades chase you. See, if I was in a rush, I'd be like, oh man, let me just enter here. Now, I probably would have still won, but entry point is everything, and you want to make sure you have the best entry point possible. All right, so again, I just want to give a quick breakdown again. Strategy is very simple. All you need is the Keltner Channel, set up default settings of 20 and 10. You can add in a moving average of 50 to make sure you're in the right down, if you know if you're going at an uptrend or a downtrend. Also, Stochastic Oscillator, keep those at the default settings of 14, 3, and 3. Let me just get into this trade real quick. I don't want to miss this one. All right, and because I knew this one was coming, sometimes when I talk, I miss my entry points. I actually did miss my entry point, which is supposed to be down there. All right, so it's very simple. When you see a green candle cross into oversold conditions, and you see stochastic oscillators also in oversold conditions, you enter for a call. When you see a red candle cross into, let me see if I can find a good one for you guys. We see a red candle cross into the that one's not really overbought. Let me see if I can find a better one for you guys. And when you see the green candle cross over into overbought conditions in the Keltner Channel, and you see the stochastic oscillator and also in overbought conditions, you enter for a put, because you know it's going to reverse down. When you see the red candle crossing into oversold conditions, and you see stochastic oscillator going into oversold conditions, that's when you reverse. You know it's going to reverse, so you do a call. And what typically you want to do is you want to wait for the line in stochastic oscillator to cross. That's your signal that the trend is going to change in your favor. All right. Let's go back to this right here. This one's moving extremely slow. Right now I'm doing OTC trading, which is very hard to do, guys. It's so hard because unlike when you're trading on the real markets during the week, there's no strength meter to look at. There's no currency the currency strength meter or the economic calendar. OTC is pretty much just a mirror of the markets from the week, which kind of could be a good thing in a way because you're just looking. It's a good way to practice. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. There it is. Hope that clears a lot of things up for you guys. It's pretty simple. But again, just make sure you always check your support resistance levels. That's also going to be always make sure you check your economic calendar. Make sure there's no 3-star news or anything going on because that can really make the markets extremely volatile, and that's when you lose trades. And when a volatile market, losing a bunch of trades using a strategy that worked before, and your emotions of why is it not working, that's a very bad recipe. It's like the perfect storm to blow an account, and trust me, I've been there before. So just make sure you just keep this thing robotic, man. I know I do a lot better when I keep things robotic and I put no emotions behind my trades. All right, guys, so I hope this helps you all out. Hope you guys having a great day and happy trading. Hope you all end this week on a green note.